Hello, Vitali. Thank you very much for accepting my invitation to my show. And I know that you're very well known in the industry, but for the sake of pure formality, if you could introduce yourself and tell us who you are and what you do on your daily basis.
Well, thank you for the invitation. So it's a great pleasure to talk about fact investing. And I'm the head of research for Europe at a company called Research Affiliates. I'm located in London, and perhaps kind of as an introduction, it's probably good to introduce both the company and myself. Research Affiliates is an asset manager that specializes in research. So we're a research-heavy institution. Then we partner with other organizations to bring to deliver the strategies to the and investors. And essentially, that specializations and that partnering business model allows us to focus best at what we are best at, which is research, creating strategies, and communicating to investors how they should be using. What are the pitfalls of investing, etc. And again, what our company is best known for is asset allocation and quantitative indexation, which is also known as smart beta or factor investing. So the many different names, and but it kind of means more or less the same thing. And then my role is head of research for Europe. And for a long time, I was located, our headquarters are actually in California, Newport Beach, California. It's a little bit sunnier than here in London. And for the most time, I was actually located in Newport. So I was with the company since 2006, but 4 years down the road, I moved to London. Most of my career at Research Affiliates, I was head of research for equities. And later, as I moved to London, kind of the goal was to be closer to our European clients. Also, the factor and smart beta conversation here tends to be half a step ahead probably over the rest of the world. And that's why we, as an organization, wanted to have a heavier research presence to kind of shorten the communication time and to learn better as an organization what's going on.
All right. So today I would like to use your great knowledge of factor investing, and I would like to bring this issue closer to investors who may be at the beginning of their, let's say, investment path. So let's start with some very basic stuff. What is the difference between passive and active investing? Is there any border we can put there? So to say that up to that moment we are passive, and beyond that it's already active approach.
So passive investing is usually delivered in an index form. It tends to be transparent and low fee. By design, passive investing is a mechanistic strategy. So basically, it's usually based on an index, and index in its rules has all the formulas to replicate it. So there is no discretion for anyone to mess with the portfolio. And now that's my definition of passive. Some may disagree, and probably some would say kind of where the origins of passive investing came from, just investing in the whole market. And the origins of that way of thinking was that markets are efficient, and that's why by investing into whole market and paying low fees and having low turnover, you'll be still ahead of most of the active managers. So that's passive. Active managers, the promise of active managers is that active managers have skill. They get money from the investors, and they use their discretion to invest. And that process could be either quant-based or fully discretionary, where investors could be using their whims, but not necessarily whims. They're fundamental research and a lot of other potentially technical signals to invest. And usually active managers, because it has skill, the promise of it is that they have skill. They charge high fees, they're not transparent, and they tend to be higher turnover strategies.
Okay. You mentioned about the traditional approach, that let's say traditional passive index funds. And as you mentioned, they offer low fees, they are liquid, they give us the broad market participation, and they match the performance of the let's say the market, and that on top of that they beat most of active managers as well, most of the time at least. So why would investors want something more on top of such a great thing, at least from the theoretical point of view? Because if purely passive approach, old, let's say, index funds are so great, why would someone look for, I don't know, for example, factor investing?
The origins of the traditional cap-weighted broad market investing are coming from the original work in finance, they reflect finance thinking of early 60s, where essentially there was in the 1950s and 60s, there was the great revolution in finance thinking, where before there was no such a science as finance. And then Harry Markowitz invented the portfolio theory and said that, well, you should diversify away the idiosyncratic risks, and by forming portfolios, you can capture the most underlying risks, and that's what you should be getting compensated for. And then later, Bill Sharp and others have extended it to CAPM model, arguing that essentially investors should only get compensated for bearing market risk. And if you have representative investing, free borrowing, and free risk taking, and kind of no frictions, then market portfolios should be the optimal portfolio for investors to hold. And so based on that knowledge, or based on that theoretization, the traditional cap-weighted passive investing came about. And why factor investing? Well, later on, as the knowledge in finance in the late 70s and 80s expanded, that's where we learned that markets are not necessarily all that efficient, and there are not only one source of risk that get compensated with a premium, but there are potentially multiple sources of risks. So, and that's where empirical finance documented factors. What are factors? Well, to give you an example, value is one factor, where it would buy stocks which are cheaper priced, where cheapness is defined as price to scale by some fundamental. So price to book, for example, or price to earnings. That's value investing. There is low beta investing, where you're going for lower risk portfolios and lower risk stocks. And so for value, for example, why would somebody want to do value investing? Well, empirically, many studies have shown that companies with low price to book, or price to sales, or price to cash flow, or price to earnings, or many other fundamentals ratios tend to outperform stocks with high price to book, growth stocks or expensive stocks. Similarly, for low beta investing, the companies with lower risk, so let's say low beta, and where beta, again, I understand that could be probably quite a bit of difference in audience knowledge of the jargon. So beta is the measure of how much stock moves with the market. And so if you select stocks which can move little with the market, and select many of these stocks, then this portfolio tend to be less risky than the market. But interestingly, that less risky portfolio doesn't have low return. So it performs on par, if not sometimes outperforming the market. So on the risk-adjusted basis, that's a very interesting investment then. And so that's where factor investing was discovered. And then later, it took probably for the business and practice of finance about 20 to 30 years to catch up. And today, smart beta strategies are offering factor investing. They're offering kind of these additional sources of potential premium, and they're packaged just like traditional passive into simple, transparent, low-fee vehicles.
Okay, but people have been investing for centuries, and although people were not aware of the existence of factors, so my question is this a new view on investing, or it's just a, let's say, formal way how to describe that from the scientist point of view?
It's more the latter. So value investing, the value investing premise is quite simple. You pay as little of a price for an asset, and if you pay for the same asset at a lower price, you'll earn higher return. It's no brainer. Investors have been doing it for centuries, and in the perhaps in the philosophical and formal way, that was formalized probably best in the 1930s by Graham and Dodd. They've written a very famous book, so they're considered generally to be fathers of value investing. And so value investing obviously has been practiced by fundamental managers ever since in a very systematic manner. Then in the 70s and 80s, there were quant active managers who were doing exactly the same things as smart beta strategy or similar things, but charging active management fees. And where the revolution for smart beta strategies, what is new, is not necessarily the finance side. It's more on the vehicle delivery, so simplicity, transparency, and low fees. And you may want to ask, does it matter? The short answer is yes, it does, because if you look at the overall managers, active managers and passive managers alike, the three biggest or probably four biggest differentiators of the return for investors, what investor gets in the end is how much fees they're paying. If they pay less fee, they earn higher return. How much transaction costs the manager experiences. The lower the transaction costs, the higher the return for the investors. And then factor investing. So investors who are exposed to certain factors, be it passive or active, they tend to get higher return if that factor gets compensated with a premium. And then so that's a very classical 1997 Mark Carhart's work. Basically, these are three important differentiators. And then there is later work where there are a number of studies that look at investor buy and hold return into mutual funds versus what investors actually get, which is kind of the dollar weighted return. And the difference, what is the difference? The difference is that investors can rotate between funds and can have and can vary the leverage of their portfolios over time. And investors basically tend to invest after a period of high performance. They tend to select managers which have outperformed and divest from managers that underperformed. And you'd think that brings a premium because this is the kind of that's the whole premise of looking at active managers. If active manager underperforms, that active manager must not have any skill, and that's why you should switch from this manager to outperforming. Well, the truth is that this rotation actually detracts about 200 basis points per annum from investor returns, because as a result of this buy high, sell low dynamic, investors sell managers who hold cheap assets. As they become cheaper, as they become more attractive, they sell more, and vice versa. They buy as assets become more and more expensive, and so as a result, not surprisingly, they underperform by about 100 basis points. And so I mentioned the simplicity and transparency as one of the attributes of smart beta investing. And in my view, they're hugely underappreciated, but they're extremely important because they allow investors to avoid bad governance mistakes and to avoid this bad rotation, which in the end handicaps investor performance by a great margin.
Okay, thank you for that. In a minute, we'll go deeper into the details of factor investing, but just to be sure that everyone who's listening or watching us can understand us, let's explain some jargon. And there are things like factor portfolio, smart beta strategy. Is there any difference between these terms? How we should understand them, especially from the practical point of view, from the point of view of an investor?
So I think the best is to go under the label and look under the hood. Just like if you're buying the car, you don't just look at the label. You want to understand what is driving it. And so basically, as I mentioned, the key differentiators are fees, transaction costs, transparency, and what factors they give you exposure for. So interestingly, we've looked at Morningstar categorizes funds, and they have several categories which are like passive, which is the traditional passive strategies, usually cap weighted. Then there is strategic, what they call strategic beta. That's their term for smart beta strategies, and there is active managers. And so, interestingly, when we looked at these mutual funds and fees that these mutual funds charge, the passive investors by that classification tend to be predominantly under 50 basis points. They say in the United States and Europe, fees distribution can be a little bit different, but that's generally very cheap, right? And where majority, more than half, is kind of less than 25 basis points. The active managers tend to have fees over 100 basis points. They promise a skill and they want to get compensated for that skill, and that makes sense. Now, when we're looking at this strategic beta category, we have this interesting shape where about half or 75% are below 50 basis points. So in terms of fees, that category is just as cheap as traditional passive. But there is a second hump over 100 basis points. And basically what these are some active managers decorating themselves as smart beta, calling themselves smart beta, and trying to ride on the popularity of the category, while they're not. So investors, so how to select and how to define? Well, look under the hook, and the features that you should be expecting are low fees, simplicity, transparency. The index should be designed well, and so what it should be reflected in is it should have low turnover and high weighted average market cap to translate into low transaction costs, and then should give you exposure to robust factors where you would see that academics, for example, would agree that we've considered enough evidence and we think that there is enough evidence for this factor to likely work. By likely work is by likely to at least have outperformed in the past.
And when we are talking about factor investing, we mainly think about equities. Can we also use factor investing apply some factor investing to, let's say, fixed income, for example. For example, to see how bonds are responding to momentum factor, let's say. Can we do that? Is it a good way to explore?
Yes. The short answer is yes. Factor investing is not just for equities. We could think of it more broadly within other asset classes like bonds that you mentioned, commodities, other instruments, and even between asset classes. As factors also drive different factors defined specifically for other kind of areas can drive performance between asset classes. Now, where probably the distinction is that equity investing is to a degree more straightforward, and markets are much more liquid. Whereas on the bond market, for example, there is quite a bit of heterogeneity in terms of types of bonds. Some trading. The kind of same company can have multiple bond issues. They can have different durations, etc. And so all of that is important for bond investing, and because of that kind of bigger heterogeneity in terms of the instruments, it lends itself harder for rules-based simple investing. Now, having said that, is it possible? Yeah, of course. And there are some investors who do that.
So what investment vehicle is, I don't know if it's a good word, the best to use for the average investor to have exposure to factors? Is it the ETF, index fund, or maybe also some investors, more sophisticated investors, can do it on their own? How do you see that?
I think the ETFs would be probably the most easily, or mutual funds more generally would be the types of vehicles the most accessible to investors, and they tend to have transparency. Now, depending on where geographically you sit, in the United States, for example, ETFs offer additional layer of benefit in terms of tax advantages, whereas mutual funds have, unless they're kind of implemented in a tax-exempt accounts, they can have another set of tax implications, where ETFs are structured a little bit more tax efficiently. Now, in Europe, that's probably less of a concern because of the difference in, depending again on jurisdiction, that can be probably different, but that distinction is less important. And now, also ETFs tend to be diversified, and fees tend to be low. Because of that, unless you're super experienced and have a lot of free time and knowledge, I'd say that going with existing established vehicle is a preferred way. But can you do it on your own? Yeah, of course you can do it. Just be careful about transaction costs, about the defining the discipline of following your strategy. By the way, like all of this tend to sound a little bit like magic. Well, you just buy these stocks and they outperform. Doesn't it sound too good to be true? Well, the truth is, you are very often getting compensated for bearing some risks. And this could be either the true risk, this could be sometimes more risky portfolios, or it could be the risk of not following the crowd and investing into companies or countries or sectors that are most hated by the market, for example. And following that discipline takes a lot of guts. So, for example, with value investing, think about last year. Well, when COVID hit, which countries became value? Well, airlines, for example, energy, financials. You should have had guts investing in airlines, increasing your allocation to airlines as their prices were falling down. Well, would it have paid off? Yeah, it did actually. To this kind of, if you were to buy airlines at about this time last year and waited for a year, you would have earned a pretty decent rate of return. But is that scary, and is that comfortable? I mean, is that comfortable? That's not comfortable at all. So you get compensated for bearing many of these real and perceived risks. And so coming back to your own implementation, when ETF does it, you don't see what's going on under the hood, and it may be a little bit more comfortable for you to just invest and forget. When you do it on your own, and your model will be telling you to buy airlines, you may start double thinking the model and doubting if it's the right time, and that's just the wrong thing to do at that time. So basically, try to think and set up that discipline for the future to be successful with that type of investing.
Right. The problem I see with factors is that we have a lot of them. I mean, actually, they are becoming so numerous and exotic that John Cochrane referred to the collection as a zoo. So, what set of characteristics, let's say, would constitute evidence that an actual factor is really a factor? I mean, it's not the data mining effect, it's not data snooped. So how can we be sure that this is a really something in it, not just data manipulation? Because as they say, if you will, torture the data, it will confess to anything. So I'm afraid that in some cases we can be also the victims, that we will just really be looking into for something and we will find it, but it's not the real thing.
Yeah. That's an absolutely real risk in fact investing, and so the way to I can describe our process at Research Affiliates. So we want for us to accept certain factors as likely to work in the future. First thing that we want to understand is the economic rationale for why it should be delivering a premium. So, for example, with value investing, the value factor tends to buy stocks that are uncomfortable and scary for many people, and tend to sell stocks that are loved by people. And when they're loved, they tend to trade at higher prices. And as a result, in the long run, that pays a premium. And so that's understanding the theory is the first step. Second, we want empirical evidence, and we want it strong and statistically significant. And so we don't want just one back test, because as you mentioned, if you torture the data enough, it will confess. And so usually, though, it's quite easy to overcome some of these data mining biases, because we know, for example, that a lot of these factors are coming from academic publications. And academics get compensated with tenure and pay for publishing articles, so they want to put their best foot forward. Now, as a result, some potential data mining is very likely to appear in much of that work. But there are ways to counteract it. So, for example, if value in the literature is defined as price to book, but we know the reason why it should work is by comparing the price to the company fundamentals. well, we can choose some other fundamentals other than the book value of equity to compare the price with. And so if it works, if the strategy gives you about the same rate of return, whether you define it by price to cash flows, price to sales, price to dividends, price to book, varying this definition doesn't result in portfolio difference, then it's more likely that it's a robust factor. Furthermore, we can a lot of the academic work is focused in the United States. And in the United States, we have the cleanest and longest data sets, the most easily accessible for academics to torture. And because of that, they tend to discover it first in the United States. Well, if it was data snooped and discovered just to work in the United States, and if it doesn't work outside of the United States, well, it's more likely to be data snooped in the first place. So by checking if it works in different geographies is the next step. Next, we wanted to work outside of just microcaps because many factors, so microcaps, these are the tiniest companies, they tend to be less liquid and more prone to mispricing and more prone to all kind of data issues. So if we find that the factor works only because of the microcaps, well, again, that's the type of factor that is not very likely to give a return advantage for investors going forward. Next is we want to make sure that the return survives the transaction costs, because many of the factor investing is done without the proper consideration of costs. And that's unfair because when investors will be trading these factors, they'll be experiencing the transaction cost, and so if the factor premium is less than transaction cost, then it's not a real factor. And then finally, another important consideration is we always have a limited data set covering very limited time period. So even if it looks on paper fantastic that we can have data going, let's say, to the 60s in the United States, that still gives us only 50 years of history. Whereas once we trade, there are the latest counts of factors documented in tier 1 academic journals alone gives us 400 plus factors. And once we start adding and looking at potential definitions, there are millions of ways in which you can define factors. And so basically, that 50-year period is, at best, what we can get is quite short. And another thing that can happen when we are looking at the short enough period is that we can be looking at just one macro or market cycle significantly skewing the picture. And so if relative valuations were to drive all of the factor premium, that those relative valuations are not likely to be expanding forever. Kind of assets can just grow indefinitely unless we're living in some Ponzi world. And so because of that, we should remove the relative revaluation type of return from the premium. And so if a factor survives, so basically earns enough alpha adjusted for revaluation, we have sound theoretical basis for why it should be working. If it's robust to perturbations and definitions, works in different geographies, and doesn't have high transaction costs, then that's more likely than not to outperform going forward. And by the way, notice that even here, I'm saying more likely than not. Even here, we should be pretty humble, and investors should realize that even if they selected 5 factors that are likely to work, even if 2 of these factors work in reality, they're still where they don't know which 2 out of 5, they're still better off than nothing.
Okay. During our discussion, you already mentioned a few factors. So I'd like to go a bit further and ask you, what are, from your experience, the factors with the most robust returns? If you could just select, I don't know, 4 or 5. By the way, I read an article by Eugene Fama who said that it's good to be limited to just the basic factors, to not multiple them. So what is your view on that? What are the best factors from your point of view, from your experience?
So the factors with the most empirical evidence are value, low beta, momentum, um, quality. But quality, and we can chat for a long time about quality. But quality defined perhaps by profitability and conservative investments. So basically, highly profitable and companies that do not grow their book of assets aggressively, um, and um, and that's close to it. Now, some of the factors that are also popular where we have less conviction for is size, for example, small cap, where Fama and French are um, Fama got his Nobel Prize, and part of it has been his work on institutionalizing factors into the academic discourse, and their Fama and French 3 and later 5 factor models are kind of the golden standard in much of the academic use. Now, their factor models include market. Now, by the way, market premium, market pays a premium, and market is a very strong factor. Now, having said that, one factor that they tend to include is size, which is small cap. And we tend to be more skeptical about size because size, although it's one of the earliest discovered factors, but it tends to benefit a lot on paper from companies that are getting delisted. And so basically many of the data sets that academics rely on, they inaccurately reflect these delisting returns. So after a company gets delisted, there is this delisting return that is posted in the database. And there is quite a bit of work saying that this delisting return is overstated when investors can actually get. So in practice, investors get less. And so once you adjust for that, for example, you don't get much of the small cap premium. So that's in short the list. So basically, market, value, low beta, momentum, and quality defined by profitability investments. Now, by the way, let me add a few more caveats. One issue, for example, with momentum is that momentum is a high turnover and high transaction cost strategy. So although on paper it looks very good, in reality, it tends to be hard to harvest with large assets. And so because of that, investors should be quite careful about how they approach momentum. So momentum tends to be best working when it's combined with other factors, and where other factors, for example, like value, tends to work against some of the momentum signals. So when trades are canceling, momentum actually starts working less as a buy initiated signal, but more as a signal which tells us when to jump into cheap opportunities, and that can help us harvest the premia without necessarily experiencing the high transaction costs.
And what is the minimum investment horizon for an investor who wants to use factors? Because as we know, people are very impatient. So they think that once they invest in the good strategy, they would like to see the results immediately. And it's hard to, I think, convince them to wait 10, 20 or more years to see the results. So from your point of view, from your research, what do you think is the minimum time horizon?
Most factors tend to outperform most of the time on 3 to 5 year horizon. Now, having said that, factors are prone to all factors are risky, and there is no magic. It's not a guaranteed return. If you're looking for guaranteed return, don't put your money on stock market. There is nothing but the guaranteed return in the stock market, and factor investing is not an exception. Factors are prone to sharp drawdowns, prolonged periods of underperformance, and potential a lot of pain. We've written an article where, for example, we asked this question. We looked at the factor returns, and we asked the question: what if we were to compare the factor monthly returns to a normal distribution? What is a normal distribution? Well, basically, it's kind of like well-behaved distribution where you don't have very fat tails. So many of the things that we're experiencing in our life are normally distributed. And so then we asked the question: how far is this deviation from normality for some of the factors? By looking at the worst realization of the last 55 years. And so if indeed these factors were normally distributed, these worst months should have been about 50 to 100 years. That's kind of just the property of waiting 55 years. We get the worst one. Well, it should be at about appearing about one in every 50 years. Now, the real frequency kind of compare it. So if it was drawn from normal distribution, the magnitude of drawdowns that we've seen, that frequency tends to be often in millions of years. And for some of the factors, the worst ones were on the order of unlikely to have occurred in our universe from the Big Bang. It's kind of 10, I don't remember the exact numbers, but it was like 10 to the 15 years. And that just tells us how big these deviations are. And that's just on monthly frequency. Sometimes some of these deviations can be followed by another month of bad performance. So bottom line is, you should be, if you want to benefit from factor investing, you should be patient, and you should have a long horizon. And it's not perhaps it's good to differentiate the gambling portfolio from an investment portfolio. If you want to gamble and you want entertainment and kick from the stock market and following the stocks, set some money aside and play with that money. Say that this is my play money. I want to select stocks. There, I will do whatever I want. But then set aside your retirement money or your kids' college money or whatever you are saving for money, where you'll want to touch that portfolio in, let's say, 10, 15, 20 years. Set it aside and just patiently invest and add to that portfolio and put it to some boring, low-cost vehicle, giving you exposure to factors.
So as George Soros says that good investing is boring, and I think that that's a good way to look at it, rather than look for some excitement in investing. But you mentioned a very interesting thing in one of your previous answer, that it's a good way to combine momentum with value. So what do you think about timing the factors? So for example, rather than buy all of them, let's say that we apply momentum on value. So when value is rebounding, is going up, then we are trying to catch that uptrend with the momentum, for example? Because you in one of your article you mentioned that people are doing that very wrongly. They are chasing returns in a very poor fashion, where exactly the result is the opposite they would expect. How do you see that timing factor issue?
Yeah. So my comment about combining value and momentum was on the stock level, but your question totally makes sense. Would you combine value and momentum on between factors, and thus trying to time factors make sense? And the short answer is yes. It does. We've seen evidence that it does help and does improve returns. We've written an article documenting that factors experience what is called factor momentum, which is once a factor outperformed, it tends to continue outperforming going forward. So that's your factor momentum, and that's not subsumed by the stock level momentum. And also similarly, there is a value effect between factors, where different factors would have some natural level of discount level. So, for example, value by definition, value portfolio is cheaper than growth portfolio. That's just by definition, because we're using the price to book, for example, to select stocks. But the discount of value to growth stocks can vary significantly over time. So, for example, if we were to select 30% most value companies versus 30% most growth companies by price to book, the average discount is about, over the last 55 years or so, has been 1 to 5. But the discount was hugely time varying. There were times when that discount was only 1 to 3. So that's when value was relatively expensive compared to growth. And there were periods when value was very cheap. So, for example, during the height of the tech bubble, that discount was about 1 to 10 or 1 to 8, well, depending on how you look at it. But 1 to 5 versus 1 to 10, that's a big difference, right? And so not surprising that when investors were investing into value strategies during the tech bubble, they experienced a significant outperformance in the years following the tech bubble. Now, today is actually a very interesting period from that perspective, because for a long time, I've thought that those people who've lived with their investment profession through the tech bubble, they've had such a fantastic time, because that would be a once in a lifetime opportunity. We're likely never to see that level of value to growth discounts ever in our lives. And interestingly, right now, that discount is even deeper. Last year, it was the widest we've ever seen in the history. So value companies were significantly discounted compared to growth companies. Now, this year, late last year and early this year, value started rebounding, but that rebound has stopped. And so today, the relative valuation is still halfway between where it was last summer and where it was at the height of the tech bubble. So from that perspective, value is showing up quite attractive. And so does it make sense to combine the value and factor momentum and factor value signals? Yes. That factor momentum is a high turnover signal. And by combining it with value, it can help better time the entry points, and you trade less. And another point is that it's not just trading less, but it can give you a more opportune time to come in, because buying a falling knife can be quite painful. So looking at momentum last year would have told you that it probably spring of last year was not the best time to be buying value companies, and so momentum would have urged you to slow down your purchases, and that's just the right thing. And so, but then once we started the reversion, that's where it is a great time to be invested in value.
You have already mentioned some risks of, let's say, factor investing. And I saw in your article titled "How Can Smart Beta Go Horribly Wrong?" that you said that we foresee, I'm just citing, we foresee the reasonable probability of a smart beta crash as a consequence of the soaring popularity of factor tilt strategies. So the problem I see here is that, first of all, as you also mentioned, that I don't know if in that article or some other one, because I read them a lot, that the common view is that smart beta strategies are factor tilts, and factor tilts are the equivalent. So how do you see that problem? Is there any difference between them? And indeed, how you see the problem that indeed we may expect to have some smart beta crash, as you described?
Let me differentiate maybe the two questions. So one is the difference between factor tilts and smart beta, and another is the factor popularity, expensiveness, and potential factor crash. So let me first answer the first question about factor tilts. Although I tend to kind of interchangeably use the factor investing and smart beta, the construction of the strategies matters a lot. And so by using cap weighted strategy and overlaying on top of it a little bit of factor investing or factor tilts can result in a subpar performance, because so cap weighting by construction is prone to overweighting overpriced stocks and underweighting underpriced stocks. And so if for example, value strategy, the performance comes from selecting cheaper companies. If you once you've selected, you then cap weight them. Within that portfolio, you will put much less weight on the most attractive stocks, because they can have low capitalization, and so that kind of those construction details can destroy the benefit of the factor investing. So the exact details of factor implementation matter, and so following alternative weighting schemes, for example, can allow you to better harvest some of the premium. So that's one. Second, in terms of implementation, transaction costs matter, and so now cap weighted strategy with a factor tilt is unlikely to give you high transaction costs, but then some other weighting schemes, for example, equal weighting, or selecting very skinny, very thin list of stocks in your portfolio, can give you high turnover and low weighted average market cap, and so can result in high transaction costs, which will eat away all the benefits of the smart beta investing. So bottom line is, even though that on paper factor investing, factor tilts, and smart beta are the same, looking under the hood and understanding the details of the design can give you kind of night and day difference, and looking for the best constructed strategy is quite important. So that's on that question of differentiation, factor tilts versus smart beta. In terms of the second issue, the popularity and potential crowdedness and the premium disappearing over time. So when we wrote the article in 2016, the how can smart beta go horribly wrong, fact investing was screaming through every channel. Basically, if you were to show up at any conference, there would be 5-6 talks about smart beta and fact investing and how it's fantastic and best thing ever created. We've seen marketing material where there were I don't even understand how some of the compliance officers allowed some of that marketing material being created, where like there were almost like 3-year guaranteed 100 out of 100 results. But that was the mood, uh, and that felt to us very disingenuous and very dangerous. First, many investors who were coming into these strategies didn't realize the risks that they were facing. And second, the popularity of some of the factors picked up by investors was coming from the fact that these factors had recent outperformance, and they were expensive. So recent great performance meant investors looked at the backtest and they saw this great strategy. It will continue outperforming, to only discover that since the moment of that strategy went live, that outperformance disappeared. And more often than not, actually mean reverted, because these strategies could have been more expensive than before. And so buying expensive strategies, not understanding the risks, and being promised something that is unrealistic is a recipe for disaster. And that's where we said, that's how can smart beta go horribly wrong. Do we mean by that smart beta doesn't make sense? No, of course not. We think that fact investing makes sense. We think that simplicity, transparency, and low fees are all to the benefits of investors. But investors should be totally realistic about what they're buying and the selection process for the strategies, and totally understand the types of risks that they're facing. So actually, funny enough, we're chatting with some of the guys from CFA who were running conferences, and what we heard, and that was just like a week ago, and what we heard was that the fact investing conversation has completely, very much close to disappeared. Why? Because factors show that they can be scary during COVID times. And factors can have these big drawdowns, and so on the back of that, it's not very good for that rosy picture that outperformance 3 out of 300 times 100% doesn't look like anything like reality. And that's why actually, but by consequences, we think that right now is probably the right time to be in fact investing, because many factors are cheap on the relative valuation basis. They're unpopular. They're shied away by most investors, and that might be the best time you could think of to enter.
You already mentioned about the fact that factor investing may be very scary, and I think that value investing showed us in the recent years that it can be really very scary. So let's talk a bit about value investing more in details. You mentioned at the very beginning of our discussion that Graham and Dodd formulated the principles of that style, let's say in the 30s of the previous century, just finding high quality stocks and buy them at cheaply, at low price. So my first question is just to understand that better. How do stocks become cheap or expensive? I mean, what causes that misprices, which creates the value premium?
You made just the right point about how we define value. And the way Graham and Dodd defined value was Let's pick compute the intrinsic value of the company by looking at its assets, which would be kind of proxy for its liquidation value, and then let's look at the cash flows that the company is likely to generate, and potentially these cash flows could be either growing or shrinking or staying stable. And by looking at that intrinsic value and discounting this future cash flows, we get a intrinsic valuation of the company. And then let's compare the market value, how much that company is traded at today versus that intrinsic value. If the market value is less than that intrinsic value, then it's a great buy. That's a value investing. Now, it doesn't mean that so sometimes value and growth investing is kind of put against each other. But that's doesn't there is not that inherent conflict. You can have a fast growing company with great fundamentals and showing fast growth, and where it can be that exponential growth can result in an extremely high intrinsic valuation of a company, and that company can look very attractive relative to market price, even if the price to book or price to current cash flows can be low. Now, that's kind of your classic definition of value. Now, because that intrinsic value language or definition is vague by design, they were formulating the principles. They didn't tell us exactly how to compute the intrinsic value, because you can't compute it. You can't define one single formula for the ever-changing world. And that's why when academics started taking these different investment styles to academic studies, they wanted something easy to compute and easy to define. And that's why they went with definitions of price to cash flows. Actually, the very first definition of value was price to earnings. And Fama and French chose price to book, again, because book value was easy to capture. It proxies for companies' capital, attributed to shareholders, and so why not? And yeah, they've seen that price to book or price to cash flow earns about the same return. Fama and French also showed that the type of risk exposure that price to book gives tends to subsume price to earnings, price to sales, etc. And so that's why it became a de facto definition of value in the academic world. But it can have different consequences for the investors and practical investing. For example, book value as a definition of value is very well capturing the company's capital, kind of in the 19th century definition of company's capital, where brick and mortar company was the main way of generating cash flows. In today's world, we rely much less on brick and mortar, and we rely much more on intangibles. So, for example, R&D investments or advertising investments or investments into sales channel. These types of investments in intangibles become a significant driver of companies' ability to generate future cash flows. Interestingly, book value is not a great way of capturing it. If anything, what book value captures, kind of by definition, is the initial contributed capital by shareholders plus retained earnings. And that book value, accounting measure of book value, is quite asymmetric into how company chooses to invest. So if a company chooses to invest, takes cash and builds a factory, or takes cash and buys a fleet of vehicles to deliver something, that kind of capital still stays on the company book value. It just changes from a financial asset to a fixed asset, but it's still book value is unchanged. If, on the other hand, that same company were to invest into R&D, or were to run into an advertising campaign, more often than not, that cost is considered, that expense is considered a cost, and is attributed to the currently produced asset. So it would be viewed as kind of added to the either SG&A, sales and general and administrative expenses, or cost of goods sold, and by this would detract from the company's book value. And so today, one problem with price to book then is that it's becoming prone to misclassifying many companies as expensive, when the truth is that book value just doesn't capture exactly the investments into intangibles. And so what we found, for example, we've published an article earlier this year where one of the elements that we showed there was that the accounting so adding intangibles to the book value significantly improves the value definition. So that is one way in which the correct accounting for the company's capital, and where capital is a proxy for company's ability to generate cash flows, gives you a better valuation metric.
In your latest article you wrote with Rob Arnott, titled "Did I Miss the Value Turn?" You say that, and I will just quote it here, value stocks stand out as the only asset class likely to generate a 5 to 10% real return over the coming decade. Shall we look now at value stocks as a bargain, although they are so scary to many people after such a long period of underperformance?
We think that they are. Basically, after the global financial crisis, we had more than a decade long financial stimulus running. We had very aggressive QE and low interest rate period, where even before the COVID crisis, we had a very long period of depressed interest rates and depressed valuations for the mainstream equities, for example. Now came COVID in 2020, and the government response to COVID was unprecedented, even by the global financial crisis measures. Now, it's true. I mean, it was well justified on many fronts, because COVID-initiated lockdowns were a crisis that we haven't experienced since the Second World War. So it is a true calamity, and if any time government should be acting, that was the right time. So now, don't take my words as trying to say that governments did something wrong. But given those actions, though, what we have is that majority of the liquidly traded assets, the yields and the valuation levels are such that they're not likely to earn the historical rates of return. So for bonds, for example, let's take bonds. Bonds, we know if we hold it to expiration, we know how much money they will give us. That's and I'm talking about the government issued bonds from let's say most developed countries. So there is very little uncertainty about that. I mean, there is tiny bit. Nothing is riskless, but there is very little uncertainty, though. And many of these bonds today are traded at negative nominal yields. So negative nominal yields, and we're talking not just small amounts. We're talking about tens of trillions of, about 10, or slightly more than 10 of trillions of dollars, uh, depending on when you're looking at it. Sometimes 11, sometimes 14, but on that order of magnitude, assets globally are priced to deliver negative nominal yield, negative nominal return. So essentially, investors are paying for someone to hold that money, and so they just guaranteed to lose money, and then that's just on paper. That's nominal money, and once we add to that the rest of the fixed income, which may have a nominal yield a little bit above 2% inflation, a little bit above zero nominal, it will still often be below the average expected 2% inflation. By the way, are we guaranteed that it will be 2% inflation? I'm not sure. Given the amount of stimulus, we may experience higher than 2% inflation. And so basically, take it as a collection of assets. When we look at fixed income, most of the fixed income assets are priced to generate you negative real return, negative return adjusted for inflation. When we're looking at equities, now equities are viewed by many as, well, that's something that keeps on growing, but that's not true. If you are looking at valuation measures like earnings yield adjusted for business cycles, that kind of tells you what you should be expecting in terms of return. And uh, and today, CAPE ratios are very high. The CAPE is cyclically adjusted PE ratios, also known as Shiller PE ratios. They're very high, and so they're very high because equities have been popular, and as investors were piling their money into U.S. equities, the valuations were going up. But does that mean that going forward they're going to continue going up? Not at all. If you're buying the same assets at higher prices, that means that return going forward is going to be lower. And so by looking at, so we have Research Affiliates has a website titled Asset Allocation Interactive, which is a subsection of Research Affiliates website, where we use a simple building blocks model to compute the expected return for asset class, for various asset classes. And so when we're doing that exercise and looking at the at yield, starting yields and starting projected global growth, etc., the expected returns that we're getting for the U.S. equity tends to be about zero real. And so then what else is left? Well, very little mainstream liquid assets. And so when we're looking by comparison, the assets that are left and that are priced more attractively are value companies and value companies within the United States and outside of the United States. So many countries like Europe is actually quite attractively priced, and many value companies in Europe are attractively priced. Now, is that a riskless investment? No, not at all. You'd be buying Royal Dutch Shells and Exxon Mobils of the world, Citibanks, and a number of other companies. And these are companies that may have their cyclical issues. So if COVID, if we have new variants of COVID translating into continuation of the lockdowns, these companies will be potentially dropping their valuations. But one question that you should be asking with some of these scary companies is how likely is the current environment to persist 2 years down the road or 3 years down the road? And my assessment is COVID will be remembered, but it won't be the thing that will be driving our day-to-day decisions 2 to 3 years down the road. I don't expect that we will be in the lockdowns. Like London, for all extensive purposes, London right now feels like it's close to back to normality. It's not fully back to normality, but it feels like it is. And largely because UK ran a pretty big and successful vaccination campaign. And today, despite the third wave, which is in terms of number of cases, is very comparable to the previous waves, but because of the high vaccination rates, the hospital occupancy and number of deaths are much lower. And once we've avoided that, there is very little reasons for the economy to go into lockdowns, because lockdowns are very expensive. And so what does that mean? That means that very likely other countries will be following similar trajectories. And that will be actually good for many of the cyclically depressed companies like energy or financials.
Regarding value, I have one more question, because we could see through COVID that, let's say, so-called virtual economy was largely unheard, and even they grew, like we have Amazon, for example. So could we take a conclusion from that basically investing in virtual economy is safer rather than to the businesses which are not virtual as Amazon, but they have to physically provide services, so they are hugely impacted when we are closing hotels, restaurants, and so on. So can we say that in the 21st century, these virtual economies are safer from the investment point of view, or it's oversimplification?
They prove to be safer to COVID-specific type of risks, for example, so from that point of view, they are safer. Now, how likely will we have more pandemics going forward? Probably we will. The number of people in the world is large, and viruses and other pathogens are trying to take advantage of this big biomass of us. But the relevant question is, how frequently are we likely to experience a pandemic similar to COVID, which is highly transmissible and very virulent and likely to kill a lot of us? Probably not that often. So if history is the guide, probably the current pandemic is slightly less, is not as severe as Spanish flu of 100 years ago, and probably so there was a Hong Kong pandemic, Hong Kong flu, in about 60s or 70s, which was not as bad as COVID, and so that gives us probably a high kind of the probability, the frequency of how frequently should we expect something like that to reoccur. And so, coming back to the question of virtual economy. Virtual economy has benefited from COVID lockdown, and a lot of what we've seen is probably also acceleration of the prior trends. So many of the retailers that went bust last year, they were struggling already. Would they have continued without COVID? Yeah, they would have. Many of them would have stayed afloat and they would have survived, but COVID just put a nail into their coffins, and that's fine. And when we were all in the lockdowns, we started using Amazon more. Now, interestingly, I think the market is pricing a lot of the higher earnings and high revenues for these companies as permanent, and perhaps as continuing growing at the same pace. And that's the danger. So I think that some of the pickup in earnings for companies like Amazon has been opportunistic and transitory, and can, if anything, drop going forward. Now, but will all of it drop to the pre-COVID levels? I don't think so. I think that Amazon has benefited from the acceleration of the trends, but that trend but Amazon today is becoming a behemoth, and many of the companies on the top of the market are becoming a behemoth, their own behemoths. And what that means, and what history shows us, is that these top dogs of the market, they don't tend to stay at that top dog position long. They tend to have high market valuations where investors just overprice them, expecting the continuation of the old trend going forward. But trees just don't grow to the sky, and that can be dangerous. So part of their demise, historically, and I'm talking about just historical precedents, has been just reversal of valuations. And part of it is, once these companies are at the very top position, they become very clear, and visible targets for competition and regulators to extract rents from them. And that's what we've started seeing. European regulators are trying to extract revenues from Google and many other of these tech giants. The issues around political engagement and censorship, etc., are entering into the discourse of regulation for companies like Facebook or Google, and then so these are the exact difficulties that can bring them down, and that can create. So if European Union were to worsen its relations with the United States, for example, in the global competition, see, why are we paying all of our money to all of these advertisers? They're essentially extracting monopolistic rents. We should maybe create and breed our own competitors for these sectors, and tax the hell out of the American companies. Is it possible? I think it's possible.
So now, for a change, I will ask you about the momentum investing, because you mentioned already during our discussion that one problem with momentum is that it's a high turnover strategy, which is just creating a lot of transaction costs, which may eat a lot of the potential profit. So how about using momentum with stock indices, for example, rather than with individual stocks? And I had here on my show already Gary Antonassi, who introduced, as he calls this, dual momentum, where in fact he's just using momentum with indices. And there are some advantages with that approach, because it has a greater scalability and also lower transaction costs, which is a problem with the individual stocks. And also there is a research by Getchy and Samonov from 2017, 2 centuries of multi-asset momentum. And they say there, among other things, that momentum with stock indices outperforms momentum with individual stocks, even before trading costs. How do you see that? Because it's not very widely used or very popular approach.
I think that works. That's the short answer. And we've ourselves have written several articles actually looking at momentum between factors. And so where the bottom line is that once you have a factor that has been outperforming, it tends to outperform in the short term, so 1 to 12 months going forward. And that outperformance is actually subsuming much of the actually between stock momentum. So it's the key driver of the momentum effect to begin with. So we think that it works, and we could talk about why it works. So the our hypothesis when we're looking at factor momentum for why it would work is likely it's coming back to two drivers. One driver is that many of the risk-related characteristics may have what scientists call short-term autocorrelation. So basically, and in terms of news and in terms of risk preferences. So when there is a bad shock to the economy, it's more likely to be followed by another bad shock. So, for example, when there was global financial crisis, there was the initial shock of some banks potentially going close to bankruptcy, and then there was likely a contagion where Bear Stearns went bust, then Lehman went, etc. So basically, that sequencing of bad events can happen over time, and that would capture part of what captures momentum captures. And similarly, on the positive side, when we had vaccines good news coming up late last year, that was the period when many value companies started rebounding, but that just didn't stop. They didn't just rebound all the way up. Early this year, we started the actual vaccine implementation. Markets started seeing vaccines are effective, and governments can be effective in delivering and doing this massive vaccination effort. And once they see it, these prices were going up month after month after month. And so that's what part of the momentum, this index of momentum effect captures. And the other potential driver is flows. So once investors start perceiving that certain asset class is becoming attractive, they start investing into it, and that further accelerates the growth, because these flows tend to be lagging the actual historical performance, and so they tend to invest after the fact of good performance, and so this flows can boost some types of stocks or some strategies up, and vice versa. By the way, on the downside, it can follow the negative side. So investors tend to get scared after bad shocks, and they tend to, after a while, when they see the prices falling down, they tend to lose patience and they get out. And those negative flows tend to drive the prices down. And in the short term, that all translates into the momentum effect.
Okay, thank you. I mean, I will not keep you here for ages because we are already talking like well over an hour. But I have some final questions here. In one of your articles titled "Smart Beta and the Pendulum of Mispricing," you focus there on long-term mean reversion. For example, value is seen as a long-term mean reversion, where after 3 to 5 years, the prices are mean reverting to the average prices. So my question is, at least maybe it's my misunderstanding, I see that on the academia, the mean reversion in the long term is let's say accepted, but how do you see the short-term mean reversion, which is even below the momentum effect? So let's say with the short term, like 1 month, so we have a long-term trend, and then we have some short-term corrections, because statistically we can see that there is such effect also in the short term, but it's not seen, I mean, short-term mean reversion as a factor. So is there a purpose for that, or why it's not maybe accepted, or how do you see that?
the short-term short-term mean reversion. So let me explain a little bit about what the literature is saying and what the empirics are showing. When looking at company prices on the horizon less than a month, there tends to be mean reversion. So basically, if the price went up last month, next month they're likely to price is likely to go down. Then on the horizon of 1 month to 12 months, there is momentum effect. Basically, if the price went up in the last 6 to 12 months, it's more likely than not to continue going up in the next 12 months or so. And then beyond that, there is mean reversion, long-term mean reversions, which is probably strongest at about 3 years. And so if we have stocks going up over the last 3 years, Amazon, for example, they tend to go down going forward, and vice versa. If energy sector has been in decline, then in the next 2-3 years, they tend to recover. And that's what drives the most of the value effect. So your question was about that very first months, what happens there? So there is that very strong short-term mean reversion documented in the literature. Now, part of what is driving that return is an artifact in the data that can be captured by investors. That is known as bid-ask bounce. Richard Roll wrote an article about it, who's a very famous finance professor, and basically his explanation, it makes a lot of sense that you have stocks quoted and bid and ask, right? And so when you are recording the prices, you're not recording the average prices, you're recording the actual transactions. And so those transactions can be either on bid and ask or ask. And so if it was kind of a little bit above the average, then next one is going to be again, either one of those, right? And so on average, that's in between. So it looks like the prices are mean reverting, and so that's part of this short-term mean reversal due to bid-ask bounce that is not capturable. That's just an artifact of the data that academics use for testing the strategies. And so once we correct for that, the efficacy, there is still some short-term mean reversion still survives, but tends to be much weaker, and it's usually not harvested because to harvest it, you need even higher turnover than even for momentum strategies. And as I mentioned, momentum as a pure investment strategy is not very feasible once you look at a large scale of assets. For that short term, that issue is even worse, because now you're not just trading based on the last 12 months of price movement, but just like on every month. So every month your portfolio looks different, and so once you factor in the transaction costs, all of the benefits disappear. Now, the way it's still used is when defining momentum, for example. Most investors skip the last months, not to trade against the short-term mean reversion.
I have one question from my listener who's asking how to choose the right ETF. Let's say that he'd like to have an exposure to value. So, are there any guidelines to make that to make it optimal choice? Because the problem is, from a point of view of an average investor, that we have thousands of ETFs, and then even if we filter them out, let's say only to value, still there's a huge number of them. So how to approach it and how to select the best one?
Probably when looking at the ETFs, I started in the beginning. Look at the costs. Look at the strategy definition, and so look under the hood. Once you've done all that, and you've narrowed down your selection to only the cheapest funds by management fees. Look at the discount that this fund is trading at. So look at the average price to book, price to sales, price to cash flow characteristics for the portfolio in the ETF. And here it may be also good to select the geographies which are more attractively priced. So, for example, looking at value, even though value in the United States is very attractively priced on the relative basis, it can still be cheap. You can still have cheaper opportunities by looking at value in Europe or value in the emerging markets. Now, they might be risky, but if you're comfortable with that type of risk, then going for the cheaper and more discounted assets, you're more likely to earn a high premium.
Okay, thank you. And I have one more question from a listener who's saying that we can slice and dice the market by many dimensions, like country, industry, factor. And he's asking what is the leading dimension? So he's asking that question from the perspective of someone who wants to have a, let's say, passive portfolio. So he will not actively change the asset allocation, but he would like to have some, let's say, hints how he should approach. Should he look on the geography, or maybe he should rather focus on industry, or maybe factors, so put more value than momentum? Are there any rule of thumbs here?
So asset valuations make sense as a selection criteria, and so from that perspective, I can Research Affiliates has a fantastic tool, in my opinion, the one that I've mentioned before, Asset Allocation Interactive, which is looking at different asset classes in multiple geographies and showing what would be the expected return given the current yields that these securities are paying and the growth rates likely to experience by these countries. So that's one tool that you can look to find opportunities. Also, Research Affiliates has a tool titled Smart Beta Interactive. So if you were to, again, Google Smart Beta Interactive, Research Affiliates has a tool looking at factors and factor relative valuations. I mentioned at some point that factors can be cheaper or expensive relative to the history, and that relative valuations tend to be highly correlated with the subsequent attractiveness, subsequent return of that factor. And so on that website, we also show the projected returns for different geographies for various factors. So look at those two tools. They do not give you the exact tickers to invest in. That's not the purpose. They give you the general direction. U.S. equity versus emerging market equity, U.S. equity versus large cap equity versus value equity, etc. And so once you've selected, then you can use that general guidance to look for the exact vehicles to invest in.
Okay, thank you for that. I will put, by the way, all the links to the show notes, so whoever is interested will find them there. And really, believe me, the last question I have for you today, do you have maybe some general recommendations for those who are interested in factor investing, or any rule of thumbs they should follow when they are willing to put some factor investing in their portfolios?
Do your homework. Do your homework and understand what drives your portfolio return. Understand your investment objectives and understand the horizon for which you're investing. and how much money you are expecting to contribute, and have discipline around it. Once you've done that, and once you've selected your portfolio, it's good to then follow a disciplined rebalancing approach, where you would, if an asset were to go up in prices, more likely than not, that asset would have fallen down over time in terms of its attractiveness. So trim down the exposure to that asset and buy what has fallen down and has become recently more attractive. And by doing this slow rebalance, don't overdo it, because in the short term there is momentum. So let it ride for a year, but then after a year, do a little bit of trimming and realize some profits, and put those profits into some recently cheaper strategies. And that rebalancing discipline plus contributing discipline, and seeing that horizon that you have in mind, and being disciplined in terms of your savings in the long term, that will make a difference. Don't expect magic. There is no such thing as magic in investing. There are no magic formulas that will earn you a higher return. Now, some assets will earn you a higher return, but they tend to be often more risky and scary for others, exactly because they're scary and risky. That's why they sometimes pay higher return. And so be prepared for bumpy ride, and as long as you are prepared and disciplined in the long run, that tends to pay. To a degree, that's kind of all I'm saying is not a rocket science. It's almost like it's good to brush your teeth and good to do your homework. In the long run, that's what pays.
Yeah. So would you agree that no pain, no gain, that the investors should be prepared for some pain in order to capture the bigger profits?
Absolutely.
Yeah. Vitali, thank you very much for your time today. It's highly appreciated. I mean, you provided us a huge amount of great knowledge about value investing, momentum investing, factor investing in general, and other things. So I'm very, very grateful for that. It was really a pleasure, and have a good day. Thank you.
Thank you very much. It was a pleasure to talk about it.
Thank you very much. Take care. Bye-bye.